Good afternoon. How is everyone out there in the virtual world doing today? My name is Jason Shepard. I'm an IRA specialist with Newview Trust. Here to do a class about small scale accounts. So that's one of the most common questions we get. What if I don't have a whole lot of money in my IRA? How do I get started? What are some options I can do? So we're going to touch on a few items here. Talk a little bit about some of the options that are available for investing in the different asset classes. We're also going to touch on a few case studies, just kind of real life examples to try and understand some different options out there on there. So before we get started, as always, Newview Trust serves as your custodian for alternative investments. We do not provide tax, legal, or investment advice, nor do we sell investments. We purely custodian IRAs, education savings accounts, health savings accounts, and solo 401ks that hold alternative investments for our clients. So those choices are all made by you, the client, and that's what we're here to talk about today are a few of those options that are available for you. First of all, what is a self-directed IRA? A self-directed IRA is an IRA in which the owner directs all investment decisions. But self-direction is purely a marketing term. You've probably heard us say this many times. It's not a type of IRA. So the IRA with us is no different than an IRA at any other custodian out there for you. What are the benefits of a self-direction? First, diversification. And that's not just diversifying within a given asset class and picking different stocks within a stock portfolio, but it can be diversifying assets across many different asset platforms. It can also be diversifying geographically. You may really want to get into real estate investing, but you can geographically diversify your portfolio by having homes here in Florida, up in the Northeast, out in the West, however you want to do that. Next is tax savings. Obviously, there are many different vehicles that you can put additional funds away tax-free, or you could also set it up to where you pay the taxes now and not pay the taxes at retirement. And we'll touch on some of those accounts here shortly. And the biggest benefit to self-direction is you get the ability to invest in what you know best. So if you're in real estate and you want to buy houses and do that, you have the ability to invest in asset classes that you know and study day in and day out. So I want to touch on the types of plans that can be self-directed. First, obviously, you have your traditional and Roth IRA accounts that have a contribution annually of $6,500. Now that is a combined. If you have both accounts, you can contribute a combined $6,500 for those accounts with an additional $1,000 combined to invest in a catch-up. There are a few employer plans that we offer. First, the solo 401k, the solo QRP. We've done classes on those recently. That one you have the ability to invest both and save both from the employee side up to the $22,500 limit, and then add an additional 25% of the net proceeds of your company for a combined total of $66,000, as well as a catch-up of $6,500 if you're over the age of 50. On top of that, we do have a couple IRA plans that can be self-directed. One is called the SEP IRA and the Simple IRA. Those are typically for small businesses, 1 or 2 employees at most. The benefit to the SEP IRA is that you have the ability to put up to $66,000 into that savings account and invest it. And then the Simple IRA has a 15.5 limit with a $3,500 catch-up at the age of 50. The main difference between those two, the other thing to consider anytime you're investing in either the SEP or the simple, if you make a certain percentage contribution out of that business and you have a common law employee, you are obligated to make that similar percentage contribution on that employee's behalf. So you want to make sure you're planning carefully, and obviously speak with a tax professional to discuss those further. The last two plans that we offer that can be self-directed, education savings account. We do use a Coverdell account that has a $2,000 contribution limit, and that can be made prior to the 18th birthday of that child. The benefit to that is anybody can contribute to that. Parents, grandparents, aunts, uncles, rich non-family members can make those contributions to that, and it can be passed down from sibling to sibling. And then health savings accounts, those come into play when you have a high deductible healthcare plan. You have the ability to put money away tax-free and invest that, and then the benefit of that is your medical care coverages are done, are paid tax deductible as well. So those are the types of accounts that can be invested. So we've talked about the types of accounts. Now let's just kind of roll forward hypothetically. You have your IRA set up, you have money in it, but it's not as large enough to purchase an entire house or make large investments. What are some options that are available to you? So real estate investment choices, short of purchasing single family homes. A lot of clients invest in foreclosures. Those can a lot of times be purchased at a discounted price. Tax liens, that is a great opportunity. It's an agreement, whereas the county is able to get a guaranteed amount back, and you can get a pretty good return. I know some of those are in the 13, 14, 15% return rate, and usually those are available at smaller balances. There is a slight process to purchase those. Those typically have to be purchased through the county, so you'd want to check locally to see exactly how to go through those. Single family homes, we've touched on those many times, so we'll skip down to real estate options. We actually have a real life event, an example of one of real estate options that we'll kind of look at a case study for that further on in the presentation. Real estate syndications are also available, where you essentially are purchasing fractional ownership. You're buying a small share in that, and you get a corresponding return on that investment. You also have unimproved land. It's not exactly how it sounds, raw land, anything like that. And then investing in commercial property. A few other real estate investment choices that may also be out there are going to be mineral rights and water rights, things like that can also be added and purchased. One of the other asset classes that we see are private equity investment choices, where you're purchasing shares either in a trust, a limited liability company, or an LLC, limited partnerships, or joint ventures. This is purchasing small shares or purchasing into an existing business and generating returns depending on how that business performs at that point. We also have clients that invest in promissory notes. These are small loans that can be written regardless, as long as you agree to terms. They can be secured loans or unsecured loans. And that just means is there collateral involved in the promissory note? Is there something tying if the borrower does not continue to pay on that? Similar to a mortgage. Mortgage is on there, obviously that's a larger balance. There are fractional funds that you can invest into where they purchase mortgages as well, so that's another option that's there for you. Convertible notes, those are interesting choices. That's where you can lend money to small businesses and startups in exchange for either compensation or shares of that company later on down the line. And then another cool one is net profit notes. This is where you can lend money to a company, and instead of benefiting as far as a share of the ownership of the company, you can then share a portion of the net profits as those come in. So great way to get involved in small businesses and help out small businesses and benefit from there. Another way to use smaller balances to purchase real estate is using leverage. So leverage is an act of using something to its maximum advantage, right? So that's money, it could be net experience, it could be your network, it can be time. But let's look at the first example there with money. So this is purchasing real estate with a non-recourse loan. An IRA is able to get a mortgage on a property. It does not have to be paid in full in order to benefit from it. So with that, let's look at a case study here. This is purchasing a home with a non-recourse loan. So the purchase price of that property in this hypothetical example has a 117 purchase price roundabout. You have just over 36,000 in your IRA. You can get a loan for that 81,000 remaining, and obviously come to terms with the institution of your choice to finish that out. Let's pause there. I want to make sure we touch on non-recourse loans. Non-recourse loan is a loan not tied to the individual. However, it is tied directly to the property. So in the event of foreclosure or anything like that, the recourse is not on a personal level. The property is just liquidated at that point to cover any remaining balance on the loan. So those are the only types of loans or mortgages that an IRA is allowed to receive. And that goes for single owner properties, that goes for any partnerships that you do. If any partner is using IRA money, they need to use those non-recourse loans. And speak to lenders that you are already working with. There's probably many that are doing these types of loans. They do typically require a higher upfront costs where you're putting 25, 30, 40% down on that, but it is available for you. So in this scenario, you sell it 18 months later, and now the property is worth 163,000. The net profit before the UDFI is 33,000. So the property is appreciated. You do have to pay a tax just on the portion that you borrowed. So that 81,000 that we talked about on the previous slide, you do pay a portion tax on that UDFI. It's unrelated debt finance income tax. So it's just on the income that you make. All right. So that means the net profit after UDFI tax is 29,000, almost $30,000. So that returns you a net proceed of close to 81% return on that initial $36,000 investment. You had to use leverage, but you were able to get quite a bit of a return in order to do that. Let's just kind of look at that. If you didn't have a non-recourse loan, that same person that maybe had that higher balance in their IRA to get it done, they did get the 117. They had that in their IRA. They sold it at that same exact price. Their net profit was only $43,000, which is just over a 36% return on that investment. So plus the other thing is they had their entire IRA potentially tied up for that same investment. Or if you had the other way and you were able to do the 36, you could have purchased multiple homes. Say you have that 117 in your IRA, could have had multiple units at that same price point and made those similar returns on your investment. So I'm going to pause there. If there's any questions in the room. No? Perfect. Pretty much covered that one. So we're going to touch on the next one, which is subject to notice. If anybody has, go backwards. Subject to is another type of leverage. This is using experience, time, and money. So subject to is slightly different, where you're basically inheriting somebody's existing mortgage at the agreed upon terms, which you want to check the state that you are investing in to see if they're still available. I know there's a few states out there that are looking at these a little closer, but essentially in this case, the property owner, was 4 months behind on their mortgage. There's very little equity in the home, so they're having trouble exiting that property. But the problem isn't the home, it's the mortgage. So they're currently paying $950 a month, but average rents in the area are going for $1,350. The seller is willing to work on a solution that prevents further damage to their credit. So they do have this subject to agreement with you. So that way you're able to come in, you're able to help them out, and then submit them and become subject to the terms of that agreement. The total Roth investment is just the $8,000. It seems like that's just the any catch-up payments that are due. Past due mortgage payments are made current, and the seller is able to pocket a few $1,000s. In exchange, they're going to exchange the deed over to you, and you now own that property instead of the previous owner, and now you're able to immediately rent it for $1,350, excuse me. And the seller is willing to work out a solution that prevents further damage to their credit. So you're able to assume ownership of that property subject to the agreed upon mortgage with a minimal investment on your end, because all you're doing is catching them up and getting them out of that property. So it's a good strategy as a long-term play where notes can be paid off via the rental income on that property. Some things to consider with this: make sure you have enough capital to cover. Make sure you have enough capital in your IRA to cover unexpected expenses, as well as repairs or even vacancy should that property not be rented. This is considered a debt leverage investment, so you're going to need to factor in UBIT and UDFI. So it is something to consider on that. You'll also need to negotiate that the underlying loan is a non-recourse loan. So that would have to be part of those agreements that you're making with that lender when you're assuming ownership of that property. UBIT on the appreciation. UBIT is unrelated business income tax, which is a portion of the unrelated to the business that you're actually doing. So instead of the real estate, it is something that can be completely avoided if you hold on to the property long enough to have the note paid in full. It just has to do with the nature of, instead of being directly the real estate investor, you're a note investor that's generating income, so it can be unrelated. It's also, just like I said at the outset, it's important to discuss this with a tax professional to ensure any issues and there's no tax implications later on. So next, we'll touch on real estate option contract. This is an option, a one-way contract that gives a buyer the first right to buy a specific property in exchange for consideration. The option usually includes a predetermined purchase price and is valid for a specified term, such as 6 months to a year. However, the buyer does not have to buy the property, whereas the seller is obligated to sell to the buyer within the terms of the contract. So me as a buyer, I can say I'm going to buy the option on this property, but I'm not obligated to purchase the property. The investor who owns the property, let's say I'm purchasing this option, I can either exercise the option and purchase the property. I can let the option expire, or I can assign the option to another investor, or I can cancel the option altogether. There's a few examples there. Option consideration: you purchase the option consideration for $10,000 at an agreed upon price for $200,000, and give me the option for 2 years. The option was later canceled 16 months later for a fee of $40,000. So those are a few options of what to do with that. Why don't we do this now, Amy? Let's pause here, and let's check on any questions that may have come in from the internet, from the attendees on the class.
Yeah, we have a couple. The first one is, what are some common mistakes or pitfalls that small IRA account holders should avoid to achieve financial success?
Absolutely, that's a good question. The most common mistake is not starting early enough, right? One of the biggest mistakes is not opening that IRA. The power of compounding interest works best over time. So the earlier you start, the more compounding that interest is going to be. Two is not contributing regularly, right? Most of us have the luxury of an employer-sponsored plan. So we have the ability to have it directly debited. I know I probably wouldn't voluntarily take the money. If it was given to me first, I wouldn't voluntarily put it in an IRA. So just having that regular contribution directly coming out of those, maximizing any employer-sponsored benefits is also another tip on that. One of the other things to consider is not staying informed, right? Financial markets and regulations change. So it's essential to keep up to date, keep attending classes like this, keep doing things similar to this, and keep growing that ever expanding information base that's out there. These days with YouTube videos, not just ours, but everything that's out there, there's no excuse not to stay up with market trends and things like that. So good question. Amy, was there another one out there?
We have two more from online. The second one was, how can individuals with limited financial resources establish a disciplined savings and investment strategy to build wealth through their IRAs?
Good question. So I think with that, first is just setting clear goals, right? How much do you want to save? How much do you want to set aside? How much do you want to invest? And have those very specific goals. Create a budget for yourself. Start small, but start now is kind of what I would say. It's the old saying is, when was the best time to plant a fruit tree? Was 10 years ago. The second best time is today. So it's time to get going if that's the case. Another thing is to automate your contributions, whether that's, if it's something that's employer, have it directly come out of that check of yours. If you're self-employed and you're in charge of that, set up an automated withdrawal and investment strategy on that side of it. Like I said, take advantage of employer plans when they're available. A lot of time there's matches and additional benefits that may be available for you. And just as you grow and as you can, increase those contributions and reinvest any dividends and gains. I mean, that's the benefit of compound interest. It's, you get the opportunity to invest a larger portion every time that the interest comes in. So that should cover that. You said there was one more, Amy?
One more. How does the power of compounding interest work in the context of small IRA accounts, and how can it be harnessed effectively?
Good question. We were just talking about compounding interest. So the best part about that is, the more you put away, the more you kind of get back. Just kind of as a simplified example, you get $100. You put the $100 in your IRA and then invest it in an activity that generates $5 extra. So that means next time you have $105 to invest, and then that generates an additional. So the more you keep rolling that interest, the more you keep snowballing that interest, the more you're going to have to invest over time. So and that's using a conservative amount of $5. Let's say that $100 investment generates 120. So now you've got a $20 profit or a 20% profit. So the next time you reinvest, you're investing $120, and that generates a 20% profit. Now you have quite a bit more, and as you continue to snowball from there, you'll just see that small initial amount can grow into a much bigger sum because it's compounding each time you invest and reallocating from there. So great questions. Like we talked about, the most important thing is to start early, right? Regardless of if you have a smaller balance, start early, be consistent about investing, invest wisely, make sure you do take the time, do your research, speak to any sort of experts out there that you plan on doing, but most importantly, don't touch it, right? IRAs work best when you don't take early withdrawals, don't take early distributions. Obviously, you're penalized if you take them out before you're 59 and a half, but don't touch it as long as you have it there, and that only hurts that compounding. So, Amy, was there anything else out there on the for the questions?
That was everything from online.
Perfect. So, went too far. Yep. Here's what to do next. If you would like to schedule a free consultation, you can scan this QR code right there, or you can call the IRA specialist team. Myself and my coworker Tabitha are on the phones all day, speaking with clients like yourself to realize those investment goals and get those set up. We'll discuss with you any account issues, anything that may be out there for you. We'll get an application filled out, transfer the funds from your current custodian, and then get you in touch with the next step, which is working with one of our great teams on our operations team here to get those investments funded and everything from there. So also next week, we will be having a conversation about maximizing returns with tax advantaged investments. So we'll touch a little bit further in deep of those different account types that are there and the maximizing of those accounts, and give you the ability to answer any questions about those deeper account types that are there and maximizing the tax benefits of each of those. So we also have episode 27 going live tomorrow morning of our podcast all about alts. We only have a few more episodes left in this season. Exciting for season 1 to come to a close, and what season 2 is going to bring for it. And then, as always, you can stay up to date with all of our new view, our content, and everything. We're always posting on Instagram and Twitter and LinkedIn, Facebook, TikTok, whatever platform you choose. Follow us there, so that way you can stay up to date with not just the class schedule, but any other events we may have going on internally from there. So we do also always want to talk about our charity, Share the Love, where we give the gift of mobility. And you can scan right there to learn more about that charitable foundation. It's a great cause, donating wheelchairs and the gift of mobility, like it says, all across the world. I know just recently the Share the Love team just recently came back from Costa Rica. So very, very important opportunity there. So I appreciate you giving the time today and look forward to seeing you